let's move on to Chapter 6A. I'm skipping 5 here because 5 was completely extra credit. There was a homework for 5 that was about Fannie Mae. If you didn't look at that at all, it's going to have no impact on your ability um, to do exam 1 or exam 2 or the final exam. And if you did do it, good for you, awesome for you. I think that's a really interesting example, and I'm sorry we didn't have time to cover it fully in class. All right, so let's get into chapter 6. So we're still looking at finance applications of accounting, but now we're going to be focused on looking at what we can draw out of all the financial statements, not just the balance sheet. And we're always going to be looking at company's history and company versus comps. And I showed you recently a real world example of an analyst report. It was quite a good report that was published in Barron's. And he did exactly this, looked at the company's history, compared it to its comps. He had a lot of great ratios in there. If you have time, I would suggest reading through that. Okay, so we were looking at this methodology through the prism of comparing United Airlines to Southwest in the Great Recession, right around the peak, right? We know that the middle of March was the actual nadir, but things were pretty bad in Q4 2008. Okay, so again, bad time. So what does that mean for the airline industry? You always want to do this qualitative analysis, right? Clearly travel is being curtailed and required travel, nobody's going to let you travel first class anymore. If you're a business person, you're going to be flying economy. If you were first class or business class, not so much anymore. Okay. Also, we were in the Iraq War, and a lot of Iraqi oil fields were shut down at the time. So there was less supply, big demand, a lot of fear that there would be even less supply. So oil was spiking up at this time, the price of oil. We looked at Southwest market positioning and logistics. So logistically, it was one of these old hub and spoke airlines. We talked about that. And it had a very high cost structure because it owned a lot of different planes, meant a lot of different mechanical inventory to keep. The mechanics need to know how to fix all these planes. The pilots need to know how to fly them. The crews need to know how to handle them. All that stuff. And clearly, the bad economy and the Gulf War were causing problems. And from a marketing perspective, they were full service. They still are first class, business class, economy class. And we contrasted them with Southwest, which at the time was it was established, but it was still an upstart, way much smaller than UAL, as we saw when we got to their sales. They were comparable, but it had about 2/3 the sales of UAL, and it was budget only. Its logistics model was that Spider on LSD model, where they would just opportunistically buy gates at airports as they became available for lease if they thought they could fit them into their existing drunken spiderweb and help them make more money. So that's called point-to-point logistics. And they only had 737s. That's come back to haunt them with the 737 MAX problem right now. But for most of their life, it just has definitely helped them cut down their cost structure a lot. Okay. And we talked about seasonal versus non-seasonal. In this class, definitely I would need to tell you if a company is seasonal. And if I don't say anything, you can assume it's not seasonal. But we talked about how can you tell if company is seasonal? You can check the pattern of sales if we're in a good, healthy environment like we are now. The economy is expanding, all that stuff. So you can look for a sine wave of sales, and that would tell you throughout the year that it's seasonal. But one thing you can always do is go to an entity's 10K report filed with the SEC, and if they are seasonal, they gotta say so in the 10K. So just get out your little search function on your browser, search for season in the 10K and see what it says. And if it's not there at all, if season is not there at all, it's not a seasonal company. So we found UAL is seasonal, Love should be seasonal too, and of course it is. And with all that in our back pocket, we jumped into ratio analysis, which is just taking numbers from companies' financial statements, making ratios out of them. And as always, when we do this, looking at a particular company, we want to look at the ratios compared to comparable companies and see how the company is doing compared to its history. Is it improving? Is it getting worse? That sort of thing. All right, so we had our three things that are important for most ratios. Remember, this was not always true for all ratios, but in general, so this one, let me say this one is always, we always want to have one sentence describing the meaning of the ratio and implying its usefulness, okay? Conceptually, that's extremely important. Every ratio that I've emphasized, you need to understand that, okay? And is bigger better or smaller better? I've said many times in class how to do that. Just hold the denominator constant. Ask yourself if the numerator increases, is that a good thing for the company or a bad thing? So that's how you answer that question. And is there a knife edge value separating good from bad? And it's typically 0, 1, or none. Okay, so a lot of the ratios had no knife edge. Some did. Okay, so like for example, the current ratio edge at 1. Why is the edge at 1? Because if it's less than 1, what does that mean? The company has more current liabilities than it has current assets, right? It has more definite obligations to pay cash within a year than it has cash and things it can convert to cash to pay for those liabilities. So less than 1 is bad. And someone brought up in office hours, which I thought was a great point, that like 1.01 is not good. In it's above 1, yeah, that's good, but in general you want to have a safety factor, right? So you want to have 1.5 times the current assets that you have current liabilities, or 2 times, or if you're a startup, 3 times. So you want a current ratio of 3. So the knife edge is just really telling us where we know below that it's definitely bad, but sometimes if you're just above that, it's not so great, but if you're below it, it's definitely not good. All right. And then we looked at our 5 approaches to ratio analysis: sales and sales growth, margins, etc. I'll march through all of them right now with us. And before we start on sales and sales growth, this has on this page, this is in this condensed Reader's Digest version of the notes, but it's also in the long form version of the notes I presented in class. Okay, this lists every ratio that I might ask you about. And I'll even go so far to say here, if I ask you very specifically about a ratio that's not on this page in a question, that will be by accident, and I'll just give everyone full credit for that question. So definitely you need to know the definitions of these ratios and is bigger better, and if there's a knife edge or not. Okay, so then we went to sales and sales growth. So sales is the cardinal measure of the size of the firm. It's not the cardinal measure, of course, of the value to owners, which is number of shares outstanding times price per share. But the scale of the firm, the size of the firm, which is not the same thing as value to owners, is always measured by sales, right? And sales growth is a great measure of firm growth. It's actually the best measure of firm growth, and it's the only one I'm going to ask you about in this class. Also, many changes in a company's performance are just due to sales decline. In the Great Recession, sales for many companies declined by like 40%. I mean, that's really shocking, but that happened. And that was really what drove a lot of bad things that happened to them. Similarly, company doing awesomely well, it might just simply be because their sales are growing so fast. Okay, great example of that for many years was Google. Google became more and more and more and more profitable just simply because their sales were growing fast and they had very, very little variable cost. Same thing with Microsoft, same thing with Facebook. Okay, so we're always going to want to look at sales and sales growth. And then we looked at an example here for sales and sales growth. So you can see that the sales of Love are about 2/3 the sales of UAL, but in the real world, that definitely makes them comparable. And we see that we looked at how to compute these numbers. So sales of UAL grew by a little more than 10% in this year, Q4 to Q1, compared to the year before. And here, the sales in Q1 grew 9% compared to the sales in Q5, and et cetera, et cetera. Okay, so sales growth is always sales new minus sales old over sales old. Okay, and then on this page, I'm not going to go over it again here because I've gone over it so much, but this page describes to you exactly how to read these tables, and really important, every single number that we computed in class, you should be able to recreate. And I've explained in class and in great gory detail in exam one information, recommended studying methodology for exam one. And thing number one is make sure that every example we do in class you can reproduce from scratch. And you should do that first because that's going to make it light years easier to do the homeworks and the in-class quizzes and things like that. All right, so I will leave you to this reminder right now. Look at exam one information. It gives you all my recommendations on how to study, and look at this page because it reminds you exactly how to read these tables. And here's some more great examples of computations of numbers. If you do these computations before you try homework 6A, it will just help you avoid so much grief. Okay, so then we went on to margin ratios. Okay, and margin ratios are typically some expense or earnings measure over sales, but in their most general sense, they could be any income statement or cash flow statement quantity over another income statement or cash flow statement quantity. Okay, and we started, we looked at profit margin, and we looked at Vermont organic apples, and so this is the profit margin, right? So profit margin, the most important margin ratio for sure. And that doesn't mean the one I'm most likely to ask you about, but definitely most important. And Vermont Organic Apples was doing pretty good with a profit margin of 5/20, which is 25% in most circles, right? And the erstwhile investment banker did a sum of the parts analysis, noting that they sold apples and they also made apple butter and sold that, and that the profit margin for the apple butter business would be way much worse than the apple business. So if they jettison that apple butter business, that's what the investment banker recommends. They've still got to pay their accountant and all that jazz. So they are going to have this other expense for accounting and stuff like that. But if they jettison the apple butter, they'll have a pile of money from selling it, and their profit margins will increase wildly. And of course, the investment banker makes a big fee. Okay, and then we looked at turnover and efficiency ratios, and these are the ones that caused everybody trouble because when we had quarterly ratios, we always annualize these. So, whoops, let me get that. Sorry, we're moving around here. I'm not trying to do that. Annualize quarterly versions of these. So my economics majors out there, you're very familiar, hopefully, with doing this kind of thing. And hey, I spelled that right. Okay. You're very familiar with doing this kind of thing. You have annualized economic numbers all the time. And for the rest of us, I'll go over once again how to get these. But turnover ratios are these ones that are mixing a balance sheet term with an income statement or a cash flow statement term, okay? And that's why we're gonna have to annualize when we have a quarterly number, okay? So we have chosen, see, here's the problem. And for my one engineer across two sections, you know what I'm talking about here. But the units of all the numbers on balance sheets are dollars or millions of dollars or something like that. And the units of all our numbers on income statements and cash flow statements are dollars per quarter or dollars per year, or something like that, okay? And because we're mixing in these ratios dollars with dollars and time, the time units aren't going to cancel out. So we have to choose what time unit we want. We choose years, okay? So we want consistent time units for these ratios. So we choose years, okay? So what does that mean? Whenever we're doing one of these ratios and it's a quarterly basis, just multiply by 4, okay? So multiply by 4. All right, multiply what? The IS or CFS number by 4, and then compute the ratio. Okay, so if it's an efficiency or turnover ratio and it's quarterly, here's all you got to do. This is always, always, always going to work, right? Multiply the income statement or cash flow statement number by 4, then compute the ratio. Always going to work. Don't do that if it's an annual number because the units are already here in years if it's an annual number. Okay, and here's exactly the same rule that I have on the previous page. So you've seen it twice here. This is also in the long form notes that I presented in class. Okay, so for turnover efficiency ratios, if you've got quarterly, take that quarterly income statement or cash flow statement number, multiply it by 4, then compute the ratio. Always gives you the annualized right answer.